Hi, everyone. Thank you for joining us today. This is Josie Martinez. I'm Senior Partner and General Counsel here at EBS, and with me is Susan Sonkin, our Compliance Specialist. We're very excited to have such a great turnout for today's PFML webinar. We know that this is a hot topic that most HR and talent leaders are looking to better understand and get ahead of. Feel free to submit your questions throughout today's session in the question box. We'll answer as many of those as we can at the very end. We'll do our best to answer all of your questions, but in the event that we run out of time, and we don't, we will make sure to answer them in our follow-up communication with you in the next few days, which will also include a recording of the webinar. So let's dive in with that. We have lots to cover. We thought we'd introduce our presentation by talking about statutory disability laws in the U.S. A handful of other states have had statutory disability laws and, to a lesser extent, family leave laws in place for several years. For example, the Hawaii disability law was enacted back in 1969, which is practically as old as I am, so that's been around for a while. And the California law was enacted in 2002. For many years, these states were outliers, but over time, more states have come around to recognizing the value of providing protections to employees who temporarily cannot work due to disability or other family situations. So in the chart above, you'll see 9 states that have, in one way or another, paid leave for an employee's own health condition or paid family leave. And you'll see Massachusetts, obviously, now is among them. We don't have time to talk in detail about how the Mass PFML compares to all the other states, but we do have a few observations. We can say that overall it compares very favorably to other programs and in many respects is more generous than most of the other programs. Like most other programs, the benefits will be provided by the state unless the employer has an approved private plan, and we'll talk about that a little bit later. That is to say that in Massachusetts, employers can participate in the Mass PFML program either through the state, or they can establish a private plan that's either fully insured or self-funded for medical leave, family leave, or both, as we will discuss today. Also, like most of the other states, the costs of the programs are shared by the employer and the employee, although the Massachusetts program shares expenses more evenly than most of the other states, which seem to place the cost either primarily with the employer or primarily on the employee. Also, the maximum benefit in Massachusetts, that period of 26 weeks, which we'll talk about, in the aggregate is in line with most states other than California, which actually allows 52 weeks of medical benefits. So also that weekly benefit amount of $850, which is the max in Massachusetts, is larger than most other states. But what we want to cover today is what is relevant to you now. Let's focus on what you need to know in 2019. And the reason being is that there's still much that's in flux right now. There's a lot of speculation, but we anticipate more guidance that will be coming. So we want to focus on what you need to know now and in 2019. So a couple of things we're going to talk about. What qualifies for the Mass PFML? What employers and employees are covered under the Mass PFML, how much leave the employees will get and what their rights are, how employees will apply for those benefits. Another big topic, the private plan exemption, what's involved with that. The employee-employer contributions, Susan is going to go over some fun contribution slides with you. And as always, we like to close with some suggested action items. So that's the agenda for today. So let's start with what qualifies for Mass PFML. Well, Mass PFML is really divided into 2 portions. You have the family leave portion and the medical leave portion. The family leave portion you can use to bond with a new dependent, like the birth of a child or an adoption situation or foster care. You can also use family leave to care for a family member who has a serious health condition. Now, that serious health condition is up in the air in terms of what it means. Is incapacity required? Well, the law is silent on this, but the regs do require incapacity. The regs actually state that it's an illness, injury, or impairment or condition that involves inpatient care. So you have to be in the hospital or in hospice or residential medical facility, or there's continuing treatment by a healthcare provider. So that comes into play during the medical leave portion as well for an employee's own serious medical condition. But back to the family leave. So in addition to bonding and caring for a family member, you can also use family leave if you have a qualifying exigency when a family member is either called to active duty or they're being notified of an active duty. So basically, if there's an emergency and a family member has to go on active duty, that would be another situation where you'd have family leave, and also in order to care for a covered service member. So those are the categories for family leave. Now, the medical leave you can use to care for an employee's own serious medical condition. And just briefly of how that's going to work, there's the Massachusetts Department of Family and Medical Leave, the department we're going to call them from here forward. That entity will administer the program, and the benefits, as we've mentioned, are going to be funded through a combination of employer and employee contributions to the state fund. And when taking a leave, an employee is going to have to submit a claim, and there's a whole process for that. They'll be submitting a claim to the department for those benefits. Now, I thought it might be helpful to just kind of see the timeline, where this started and where we're going to end up. So on June 28th, 2018, Governor Charlie Baker signed a bill requiring employers in Massachusetts to provide FMLA benefits to employees in the Commonwealth, similar to many other states that we've talked about. We want to stress that there may be changes to these regulations. There probably will be changes to these regulations because the process is not yet final. So we will probably have another webinar later in the summer to report any of these updates. So the next dates that are important, January through March were the draft regulations. Again, there's been changes to those, and we anticipate there may be more changes to those. The next big date really was June 30th. The posters and notification to the employees about the Mass PFML must be in place by then. July 1st is a critical date. That's when the final regulations should be issued. I say should be issued because one never knows, but hopefully we will have those by July 1st. And most importantly, payroll deductions will begin on July 1st. The next important date is September 20th because that is the deadline by which an employer has to submit the private plan exemption if they decide to go that route, and that has to be submitted to the department for the first quarter. October 31st is a critical date as well because the earnings report and contributions are due to the state for that July through September timeframe through the Max Tax Connect portal. And then in terms of benefits, those will actually be rolled out in 2021. January 1st will be the majority of the benefits, but there are some benefits that will kick in July 1st, 2021. So that just gives you a quick timeline of where things were and where we're at now and where we're heading for the remainder of 2019 and into 2021. So now let's talk about which employers are covered by the Mass PFML law. You're probably wondering, are you subject to this, to these laws and regulations? Well, all private employers employing one or more individuals in Massachusetts are subject to the law. That means any employer with as few as one employee are covered by this law. And an employer is identified by its EIN. Okay, so in addition to private employers, there's also covered business entities. And a covered business entity is a business that has independent contractors that make up more than 50% of its workforce. Another category of employers that are covered by PFML in Massachusetts are state or federal employers, and also cities, towns, and municipalities, but only if they opt into the program. So they have some flexibility with that. The last category I wanted to cover are self-employed individuals. A self-employed individual can elect to participate in the program. If they do so, they have to elect for an initial period of 3 years. So they're committed for 3 years, and they can't collect benefits until they have contributed premium for at least 2 calendar quarters. So my guess is that most of the folks on the phone probably fall into the category of employers that are covered by the Mass PFML, because there's hardly any that aren't covered by the Mass PFML. So now let's talk about what you need to do. How much leave will these employees get? Well, this slide shows the maximum coverage periods for a Mass PFML leave. Keep in mind that there is a 7-day unpaid wait period before the benefits begin. So a 12-week benefit period means 1 week of unpaid leave and 11 weeks of paid leave. Keep in mind, this is important, that the wait period is waived if the employee takes disability leave during pregnancy and immediately moves to family bonding leave. So in that situation, the wait period would actually be waived. So let's just run through what the time periods we're talking about here. So this is beginning in 2021. Keep that in mind, 2021, January 1st. Covered individuals are eligible for up to 26 weeks in the aggregate. That means combined paid family and medical leave in a benefit year. Now, let's talk about that benefit year, because it's different than what you might think you already know about the benefit year, because they've defined it a little differently here. The benefit year is the 52-week period beginning on the Sunday immediately preceding the first day of leave taken for MPFL, rolling forward. Okay, so that's the definition of a benefit year under the Mass paid family leave. Okay, so starting January 1st, okay, an employee can get up to 20 weeks of paid medical leave to address their own serious health condition. So 20 weeks for the employee's own serious health condition. You can get up to 12 weeks of paid family leave to bond with a child during those first 12 months of either the birth, adoption, or foster placement. Also up to 12 weeks because of that emergency situation relating to a family member who's on active duty or has been called to active duty. And then up to 26 weeks of paid leave to care for a covered service member with a serious health condition. So all of that kicks in January 1st, 2021. Now, months later, July 1st, 2021, a covered Massachusetts worker can get up to 12 weeks of paid family leave to care for a family member who has a serious medical condition. So it's broken out into January and July, and those are the various time periods. Okay? Mass paid family medical leave will also be available for intermittent or reduced schedule leave. Similar to FMLA, the intermittent leave to bond with a new dependent will only be available if the employer agrees to that. The minimum increment for intermittent leave will be 1 hour. An employee who takes on an intermittent or reduced leave schedule will get a prorated reduced weekly benefit. Also, the leave allotment will be based on the number of hours or days an employee works, so that when a part-time employee takes leave, the amount of leave available will be proportional to the amount of time that the employee normally works. Now let's talk about what the Mass PFML employee rights are. Simply stated, it's job restoration to the same or equivalent position as when the employee went out. Okay? The employee still has a right to accrue vacation time, to accrue sick leave, bonuses, etc. The time of leave does not need to be treated as credited service for purpose of benefit accrual or vesting and eligibility to participate. So that's really under the category of job protection. There is a caveat to that job protection. The employer shall not be required to restore the employee to the similar and same position if other employees who are similarly situated of equal length of service, credit, in the same or equivalent position have been laid off, and that's been due to economic changes or changes in the operating conditions. So in that layoff situation, there is an exception to that job protection. Okay? There's benefit protection. There's got to be continuation of health benefits. There's got to be the same contribution amounts while the employee is out on leave. So pretty straightforward there. And the last thing that is super important with respect to employee rights is the anti-retaliation. The law is very, very clear that there is a presumption of retaliation if there's any negative change whatsoever in seniority, status, employment benefits, pay, or other terms while the employee is out on leave, or, and this is important, or within 6 months following the leave or their return. So that's 6 months afterwards as well. So again, a presumption of retaliation under the law, so please keep that in mind. Now I'm going to turn it over to Susan to talk about how much pay workers will receive.
Thank you. Hi, this is Susan Sonkin. We're going to give Josie a minute to catch her breath as I review how much pay workers will get under the Mass PFML. When a worker qualifies for a benefit, the state will compare the worker's average weekly wage to the state's average weekly wage and calculate the worker's benefit. The worker will get a percentage of their average weekly wage up to a maximum amount. The maximum benefit is intended to be about 64% of the state average weekly wage, and currently the state average weekly wage is $1,383, which is about the equivalent of $71,937 a year. So the current maximum weekly benefit has been set at $850 a week. This amount is going to be adjusted by October 1 of each year, and the adjusted amount will be effective on the following January 1st. By the way, we don't know yet whether the benefit will be taxable income to the worker. That is one more detail yet to be determined. So, how will the benefit be calculated? On this slide, we're going to run through a simple example where the employee earns $1,000 a week. And the first part of the calculation replaces 80% of the employee's average wage up to 50% of the state average weekly wage. So in our example, half of the state average weekly wage equals $691.50. So that amount multiplied by 80% equals $553.20. This is the first part of the employee benefit calculation. In the second part of the calculation, the state will replace 50% of the employee's wage in excess of 50% of the state average weekly wage. Now, that's a bit of a mouthful, so we're going to break that down. Again, our employee's average weekly wage is $1,000 per week, and 50% of the state average weekly wage is $691.50. So the employee's earnings in excess of $691.50 is $308.50. The state will replace 50% of the $308.50, and that comes to $154.25. So now we add the benefit from the first part of the calculation, which is the $553.20, to the benefit from the second part of the calculation, which is $154.25, to get a total benefit of $707.45 per week, which in this case is about 70% of pay for that employee. So in this example, the employee's benefit of $707.45 is less than the maximum benefit of $850, so that is what this worker would get as a weekly benefit. If the employee's average weekly wage was more than $1,000 a week, say such as $1,500 a week, then the result of the calculation would be more than $850, but the maximum benefit is set at $850 per week, so $850 is what that higher wage employee would get. Okay.
I don't know about those of you on the phone, but all that math just gave me a headache. So we are going to take a break from the math for a little bit, and we're going to look at which workers will be eligible for benefits. So beginning in 2021, which is when the benefits kick in, an individual will be eligible to file for benefits if they're in one of four categories. Okay, if the employee works for a Massachusetts employer and they meet the financial eligibility test, which we're going to talk about in the next slide, they would be eligible to file for benefits. If the individual is a former employee who files a claim within 26 weeks of their termination, they would also be eligible to file for benefits. If the individual is a contract worker and the employer has contributed to the fund and they meet the financial eligibility test that we'll talk about next slide, they would also be eligible to file for benefits. And lastly, if they're self-employed, if they have coverage and they've contributed to the fund for at least 2 of the last 4 quarters and they meet the financial eligibility test, then they also could file for benefits. Before I tackle the financial eligibility test, I just want to remind folks and encourage you to send in any questions that you wish and type them into the box, and we'll address those at the end of the presentation. So what is the financial eligibility test? Well, eligibility here is not measured by the number of hours worked for the employer or by whether the employee works part or full-time. It's a completely different test. Rather, employees are eligible for PFMLA if they meet the eligibility requirements of the Commonwealth's unemployment compensation law and is based on the amount of compensation that the employee has earned while working for any employer in Massachusetts during the last 4 completed quarters, not necessarily the specific current employer. So what that means is that eligibility is transferable when the employee switches employers. So a new employee to your organization may be eligible if they previously satisfied the eligibility requirements during the requisite time period at a prior Massachusetts employer. So keep that in mind. If they're already eligible, then when they come to you, they'll be eligible. So the financial eligibility test looks at if the individual has received total wages as an employee from a Massachusetts employer, and that wage equals or exceeds 30 times the individual's weekly unemployment benefit amount, so approximately 15 or more weeks of earnings, and the wages total at least $4,700 during the 12 months preceding a claim for benefits. So that is the financial eligibility test. Now, assuming the individual qualifies for the benefit, and assuming the employer falls under Mass PFML, how will the individual apply for benefit? Well, if the need for leave is foreseeable, then the employee must give the employer at least 30 days notice. If it's not foreseeable, then the employee must give the employer notice as soon as practical. The employer can enforce those usual and customary call-in requirements that they have at their workplace. Also, when planning medical treatment, the employee must consult with the employer to make a reasonable effort to schedule the treatments so as not to disrupt the employer's daily operations. That, of course, is subject to approval by the healthcare provider. So the chart before you, the slide that you're looking at, shows you what will be included in a 30 days notice, right? So it's going to have the start date, the anticipated length of the leave, the type of leave, and when they think they will return. So that's the basic information that's going to be on the application for leave. After the employee applies for benefits, then the department will provide notice to both the employee and the employer whether it's been approved or denied. An approval statement will include the reason for leave and the duration of the leave, when the leave expires, and if it's intermittent, then the frequency and duration of the intermittent leave. The proposed regulations at this time actually do incorporate some provisions around the notifications, the fitness for duty certifications, some of the notices of the essential job functions, leave extension requests, et cetera. So there's a little bit more detail. But Susan and I felt that we shouldn't discuss it at this time because we really need to focus on what's important in 2019, and those final regulations are not yet final. So we will address those issues as we get closer to the actual benefit administration in 2021. We don't want to give you information now that might change in a few months. So for now, all you really need to know is how the individual will apply for benefit and what the general information that they would need to provide, and that the employer would get 30 days notice. So now let's talk about how the state plan benefits would coordinate with the employer plan. It's pretty straightforward in theory when you think about the two sources of providing benefits. The department will contact the employer to find out what benefits the employer is going to pay the employee while they're on leave. Why? Because there's no double dipping, right? So you never want the employee to get more than 100% of their pay during leave, so they're going to offset each other, okay? So the employer may require that medical or family leave taken under the employer disability or family leave plan run concurrently with the Mass PFML. The weekly benefit paid by the state will then be reduced by the amount that the employee receives from the employer STD or the paid family leave if the aggregate exceeds 100% of the employee's regular pay. Again, you never want to pay more than 100% when they're out on leave. If the employer reports that its plan is going to pay 100% of the employee's regular wages, then the state won't provide any benefit to the employee. And in the situation where the state does not provide benefits because there's an excess employer benefit payment there, then the employer is going to apply for reimbursement of the amount that the state would have paid to the employee. Employers obviously are going to have to track leave entitlements separately for all of those reasons. And finally, I want to note that employees can choose but may not be required, but they can choose to use paid sick, vacation, or personal time while they're on mass paid family medical leave, okay? And they'll probably use the accrued paid leave during that 7-day wait period, okay? So think of it as an offset. And again, if the employer is paying 100% of that, the state won't pay anything to the employee. And in the case where they're not providing, the state is not providing benefits, the employer can get reimbursement. How will the Mass Paid Family Medical Leave interact with other state or federal laws? Well, it may run concurrently with FMLA, with that Massachusetts Parental Leave Act, and with the Massachusetts Earned Sick Time Act. And the reason we say may is because it's intended to run concurrently, but because there are so many different provisions between the PFML and the other laws, they won't necessarily run concurrently all the time. So conceivably, an employee might take leave under one statute and then the other leave because of different eligibility, right? So employees may be eligible for PFML, but not eligible for other statutory leave entitlements. Maybe they didn't work the required time period, so they didn't meet eligibility. Maybe the condition doesn't apply, etc. So that's why we say that it may run concurrently. Just to give you an example of what we're talking about, here are some, not all, but some of the differences between Mass PFML and FMLA, for example. Right off the bat, when you're looking at the family member definition, the biggest difference between Mass PFML and the FMLA law is that family member, the definition of family member under Mass PFML has been expanded, so it's a much broader definition. It includes domestic partners, parent of a spouse or domestic partner, grandparent, grandchild, siblings. So again, a much broader definition between PFML and FMLA. When you're looking at leave duration, the PFML has that 20 weeks medical leave for the employee's own serious health condition. When you look at the leave year method, we just talked about a little while ago, the benefit year is defined very differently under the PFML versus what FMLA considers the leave year method. The intermittent leave under PFML has a 1-year minimum increment. Under FMLA, it's no greater than 1 hour. And then the eligibility finally is the unemployment compensation test under PFML. Whereas, you know, under FMLA you have, under FMLA you have the hours that an employee's worked, you have to consider the location, whether you have 50 or more employees. So very different tests, and definitions under these two statutes. So that's one of the reasons why they may run concurrently, but you might, and an employee might be eligible under one, but not the other. So let's look at some key dates of what's going to happen this year. The posters, you should get those up soon, certainly before the end of June. The sooner the better with the posters. June 30th, you have to issue the notices to the employees and make sure you're going to collect their acknowledgments. We'll talk about that in a minute. July 1st, we're hoping, fingers crossed, for the final regulations. July 1st is also when payroll deductions will begin, on or after July 1st. So we'll have to start those deductions. Also, that's the first employee reportable earnings quarter starts then. Now you've got September 20th is the deadline to apply for a private plan exemption and submit that application through Mass Tax Connect. So September 20th is an important date if you are considering doing a private plan. September 30th is the end of that first employee reporting earnings quarter. And then October, by the end of October, employers have to transmit that first quarterly wage report. Everything is going through Mass Tax Connect. So that's what's happening this year. Let's talk about the poster. This is the poster that needs to be posted in English. And also I want to remind the employers on the line who might have employees, a critical mass of employees that speak another language. You need to post the poster in each language, which is the primary language of 5 or more members of the workplace. And I want to note that failure to comply with the posting or notice requirements results in a penalty, which can be up to $50 per employee. So keep that in mind. You want to get those posters up by the end of the month, by the end of June. The next thing I want to talk about is that notice. There is a model notice that you can use that needs to be distributed to all employees by June 30th. So by the end of next month, which is right around the corner, employees must receive this notice. What's critically important to note is that you need a signed acknowledgement of the employee's receipt of the notice. The good news is that you can do this electronically, so that should alleviate some of the administrative task of it, but you need a signed acknowledgement. Also, not only is this notice given to all the employees that you currently have in your organization, but new hires need to receive this notice within 30 days of their first date of employment. So it has to be in the employee packet, the new hire packet. You know, the department has indicated that if an individual employee fails to acknowledge receipt, it will consider an employer to have fulfilled its notice obligation if the employer can establish that it actually provided the notice and there was an opportunity to acknowledge to each member of the workforce. So you have a little bit of wiggle room there, but I highly suggest and recommend that you make sure you get a signed acknowledgement from every employee and keep that in your records. And again, just don't forget that you have to provide the notice in a different language as well. So the notice, I don't know if you've seen the notice, we've sent it out on our prior alerts, but it basically just gives the general information about PFML, about the employee's obligations, so they understand why they have this additional new obligation, the employer's obligations, and some general employer information. Okay, so now we're coming up to one of our biggest topics. We've been hearing this question almost daily for the past couple of months. Should we do a private plan? That's a good question. I don't have a yes or no for all of you. The answer is it depends. So I want to educate you on what's required to have a private plan so that then you can determine whether you think this is best for your organization. So basically, a private plan, I know there's a lot of words on this slide, but here's the gist. The private plan has to provide the same or better benefits, the same or better employee protections at the same or better cost to your employees, okay? So it has to be the same or better, the private plan. The private plan exemption will be effective for 1 year only and then has to be renewed annually. and the application is available through Mass Tax Connect. Now, again, you can do a fully insured private plan or a self-funded private plan. If you're going to do a self-funded private plan, you actually have to have a bond. The regulations call it a surety bond. For every 25 employees, the department requires a bond value, and they're listed here on this slide, $19,000 for family leave plans, $51,000 for medical leave plans, and $70,000 for combined medical leave, family leave plans. So that's for every 25 employees. I want to note, and I know I've said this deadline before, but it's super important that the deadline to apply for the private plan exemption for this first quarter is September 20th, 2019, so a few months from now. The state says that it will take about 1 to 2 days to review the plans after they're submitted through Mass Tax Connect. So within a couple of days, you should know whether your private plan actually qualifies.
On the right one.
So the key features of a qualifying private medical family leave plan, we made up this slide because I thought it was a good cheat sheet. Sorry, let me just back up a little bit here. Here we go. So this is the key features of a qualifying private medical family leave plan. It's a cheat sheet. And you'll see that obviously your private plan has to apply to all eligible employees as of the date of hire, okay? If you have independent contractors that comprise more than 50% of your workforce, they have to apply, it has to apply to that. Also, former employees are eligible for 26 weeks following their termination or separation. So again, those are the individuals that qualify for the private plan. It has to have the same or better benefits and the same amount of leave as the PFML. Also, one important thing to note about the private plan, and this is whether you're doing it privately or self-funded, you have to have that expanded definition of the family member. So it has to include in-laws, domestic partners, parents of domestic partners, and all the other categories I mentioned before. So it has to have that expanded definition of a family member. Also, they have to qualify for that exigency in the case of a service member called to service or to care for a covered service member. Obviously, the plan has to have the same job protections, continuation of benefits, etc., that the PFML has. So it basically has to mirror, whether you're fully insured or self-insuring this, it has to mirror the PFML. And also, very important, this was actually written in the law, that the plan must state that all presumptions are made in favor of availability of leave and payment of benefits. So also keep in mind that the department can audit the plan, and they can require periodic reporting to ensure that it's compliant. They can obviously withdraw approval for the plan if anything changes or they feel it violates the requirements. So there is this ongoing audit right that they have to make sure that the plans are compliant and qualify. If you're certain that you want to offer a self-insured private plan, we recommend that you submit an application for a self-insured private plan via Mass Tax Connect so that you can get approval by September 20th. The department has advised that employers whose private plan exemptions are approved by September 20th will not be required to remit the first quarter premiums to the DOR, but may keep them as a reserve for their private plan administration. So you would not have to pay those premiums to the DOR if you get the plan qualified by September 20th. So essentially the plan would be deemed retroactive to July 1st. The DOR has released a very helpful video tutorial on how to submit a private plan exemption application, and that's a YouTube video, and we provide the link at the end of this presentation. So one of the things we're going to do with this webinar, we're trying to be all technology savvy here, we're going to try to do some poll questions. So the first poll question we have is, does your organization plan to sponsor a private plan in lieu of participating in the state plan. So this will be anonymous, so please go ahead and do your responses. The poll is now open, and we'd love to hear what your thoughts are on that. So please respond to the poll question, and we will discuss those results in a minute. Okay, we're collecting all the poll responses. Very exciting. Okay. While you're doing that, here's just a list of the carriers that are ready to provide support. Prudential seems to be the front runner right now. They're just coming out with the fully insured and some self-funded options. We've heard from the other carriers that we've surveyed. They are in the works for a lot, so that's why you'll see the TBD, to be determined, by the majority of them. We are getting these, honestly, where they're trickling in, they're working on it, so I think we will have additional information from the various carriers within the next 30 days. Obviously everyone is aware of that September 20th deadline, and so we'll keep you updated with any new developments. So we have results for the poll questions are: does your organization plan to sponsor a private plan in lieu of participating in the state plan? So 50% of you on the call have responded no. 40% have responded not sure yet, but 9% have responded yes. So 9% are thinking of doing it, 50% are saying no for sure, and 40% the jury is still out. So maybe by the end of this presentation, you'll have a better sense of which way you want to go. So let's talk about your STD plan. You're probably wondering, a lot of you have STD plans in place, and will your current STD policy qualify as a private plan? Because I could see you're probably thinking there are some similarities. Unfortunately, as they are currently written, STD policies do not qualify as a private plan. They do not qualify as a private plan. Generally, STD policies do not have the same provisions as the state plan in terms of eligibility, benefits duration, benefit amount, the definition of disability, intermittent leave. All those areas can be very different. So in most cases, employers that retain their STD policies and participate in the public plan, the STD policy will be amended to offset the PFML. As we talked about before, there has to be that offset provision. And the STD premiums may get reduced as a result of the offset when you take into account the state plan. So here's just a quick chart to give you an example of a typical STD plan versus the mass PFML. Okay, so right off the bat, you're looking at eligibility is very different. The PFML uses that unemployment compensation test, and they also have that 20 weeks post-termination provision for terminated employees, whereas the STD plan usually looks at hours worked, and there's usually no post-termination rights. I'm not going to run through all of them, but as you can see, there's definitely, the standard of incapacity is very different. That serious health condition is very different than the totally or partially disabled. The waiting period, many STD plans do not forego the elimination period for pregnancy, whereas the PFML, there's that 7-day waiting period, but that's an exception if the pregnancy or childbirth immediately is followed by family leave. So there's enough differences between the two plans that the STD plans you have in place now would not qualify as a private plan to satisfy the state requirements for PFML. Sorry to say. So we now have another poll question, which is, does your organization plan to eliminate your STD benefit and use the state plan instead? So we just went through how your current STD plan would not qualify as a private plan. Now I'd like to know whether your organization plans to eliminate your STD benefit, because now you're going to have the state plan instead. And I can see where that might be your thought, but I caution you on that because the medical leave under the PFML and the STD are not the same, and they have very different provisions. STD will continue to be a valuable employee benefit. In particular, if you cancel the STD benefits before the state benefits become available, you could leave your employees unprotected if they become seriously disabled. You may also want to consider the needs of your higher paid employees and whether the state program will leave them underprotected. So in the end, it's really apples and oranges. The benefits are not the same, and they'll definitely leave a gap for employees, especially those higher income employees. So curiously, let's see what the results are for whether you're going to eliminate your STD. And it looks like 44% of you on the phone said you are not going to eliminate your STD benefit, 3% saying yes, and 38% are not sure. So seems like the majority, well, it's almost split. Not sure yet, and 44% are saying no. So with that, I'm going to turn it over to Susan to talk more math. So I hope you're having some caffeine because...
Okay, thank you. All right. So now we're going to talk about the employer and the employee contributions that are going to begin this July. Employers and employees will share in the contribution costs of the Mass PFML benefits. And although the benefits are not going to begin until 2021, the state needs contributions to the state fund to start this year so that the state will have sufficient funds on hand to begin paying benefits in 2021. So here's how this is going to work. Employers will report employee wages to the state on a quarterly basis. The state will receive those earnings reports and calculate a quarterly premium invoice back to the employer, and the employer will pay that invoice within a set period of time after the end of each quarter. So again, employers and employees are supposed to share in the cost of the program, so employers are allowed to take certain limited deductions from employee pay and forward those deductions to the state as part of the total amount that the employer owes to the state to pay the premium invoice. Employers can start taking those employee deductions with the first payroll on or after July 1, which will be the first day of the first quarter of this program. And the first quarter will run from July 1 through September 30th. And then on September 30th, employers will send their first quarter earnings report to the state, and the state will send the first quarter premium invoice back to the employer, and the employer will pay the first quarterly premium to the state by October 30th. And this will be the procedure moving forward quarter by quarter, and this will all happen through the Mass Tax Connect web portal. By the way, the employer may pay some or all of the employee's share of the contribution if the employer wants to do that. And if the employer does pay the employee's share, then the employer will need to report to the state exactly how much of the employee's share the employer is paying. Okay, so the initial gross amount of contribution for any given employee will be 0.63% of wages up to the Social Security wage base. So if I earn, say, $1,000 a week, the state will invoice $6.30 per week, or $327.60 per year as the total contribution for me. The Social Security wage base this year is $132,900, and 0.63% of that is $837, so the maximum annual contribution that would be billed for any employee, no matter how high their wages are, is at $837. Now, the 0.63% contribution gets broken down to a medical leave component and a family leave component. And those two components get further broken down to an employer share and an employee share of the medical leave component and the family leave component, which we will discuss in the following slides. Note that there is a special rule for smaller employers, which are defined as employers with fewer than 25 employees. Smaller employers will not have to pay the employer's share of the components of the contribution. They will only have to forward employee contributions to the state. And it's important to remember, though, that smaller employers are still covered by the Mass PFML law. They just don't have to contribute their own funds to it. Okay, so on this slide, we will review the breakout of the employer and employee contribution amounts for a large employer. And then we will run through a numerical example in the following slide. Again, a large employer is one with 25 or more employees. By the way, this graphic is from the Massachusetts State website, which has a lot of helpful information for employers about this new law, and I would encourage you all to check it out. I think this graphic really shows how the contribution breakdown works in a very clear way. And at the top, we have the total contribution for an employee, which is again 0.63% of pay, up to the Social Security wage base, which we then break out that 0.63% of pay to a medical leave component and a family leave component. And the Massachusetts actuaries have determined how much of the 0.63% needs to be allocated to medical leave and how much needs to be allocated to family leave. And they have determined that 82.5% of the 0.63% gets allocated to medical leave, and that 17.5% of the 0.63% gets allocated to family leave. And as the graphic shows us in the middle row, as a percentage of payroll, that comes to 0.52% of pay for the medical leave component and 0.11% of pay for the family leave component. And these two components are further broken down to an employer share and an employee share. And on the left side, we see that the employer share of the medical leave component is 60%, and the employee share of the medical leave component is 40%. And this means that the large employer must contribute at least 60% of the medical component, and the employer cannot contribute more, the employer cannot deduct more than 40% of the medical component from employee pay. On the right side, we see the employer and employee share of the family leave component, and here we see that the employer share of the family leave component is 0, and the employee share is 100%. So this means that employers are not going to be required to contribute for family leave benefits of the Mass PFML. This portion of the Mass PFML will be paid for by employees only, unless the employer voluntarily pays for this on behalf of their employees. This slide shows the contribution breakdown for a small employer, those with fewer than 25 employees, and just as in the previous slide, we begin at the top with the same total contribution of 0.63% of pay up to the Social Security wage base, and as in the previous slide, we break that out to a medical leave and a family leave component, and the medical leave component is again 0.52% of pay, and the family leave component is again 0.11% of pay, and these two components are further broken down to employer and employee shares. But on the left side, we see that the employer share of the medical leave component is 0%, while the employee share of the medical leave component is still 40%. So this means that the small employer doesn't have to contribute at all to the medical component. The contribution required from a large employer is waived for small employers. So the small employer will still deduct 40% of the medical component from employee pay and will still forward that employee deduction to the state fund. Again, on the right side, we see the employer and employee share of the family leave component, and here again we see that the employer share of the family leave component is 0, and the employee share of the family leave component is 100%. So again, this portion of the Mass PFML will be paid for by employees only, unless the employer voluntarily pays this on behalf of their employees. So now we're going to run through a numerical example. On this slide, we see an example for an employer and an employee contribution for a large employer where the employee earns $1,000 per week. And as we saw on the previous slides, the total contribution for an employee is 0.63% of earnings. So in this slide, that is $6.30. And as we discussed in the last few slides, that 0.63% of payroll gets broken down to two parts, which come to 0.52% of pay for medical and 0.11% of pay for family. And in our example, this means we multiply the $1,000 by 0.52% to get the medical leave contribution, which comes to $5.20. And we then have to break down that $5.20 to an employer share and an employee share. And the state tells us that we can't deduct more than 40% of the medical contribution from employee pay. So we multiply the $5.20 by 40% to get the employee medical share, which comes to $2.08. We then multiply the $5.20 by 60% to get the employer medical share, which comes to $3.12. And we do a similar calculation for the family leave contribution. And again, as a percent of payroll, that is 0.11% of pay. So we multiply the $1,000 by 0.11% to get the family leave contribution, which comes to $1.10. So the state tells us that the employer doesn't have to contribute towards the family leave, so we can deduct the entire $1.10 from employee pay. So now we can determine the final employer and employee contribution shares. Again, the total contribution that will be forwarded to the state for this employee who earns $1,000 this week will be $6.30, but the employer portion of that $6.30 will be $3.12 that the employer contributes towards medical leave. And again, small employers don't have to contribute that part. The employee portion of the $6.30 will be $3.18, which is comprised of the $2.08 the employee has to contribute towards medical leave, plus the $1.10 that the employee has to contribute towards family leave. So at $3.12 from the employer and $3.18 from the employee, you can see that at the end of the day, it comes to roughly a 50-50 split between the employer and the employee to fund the Mass PFML benefit.
Okay, hopefully you followed all that math. Thank you, Susan. That was a lot to take in. So we're going to ask a real quick poll question here. Does your organization plan to pick up some or all of the employee contributions for medical or family leave? I'm going to keep going, and then I'll tell you what those poll results are. Given what Susan has explained about the contributions, if you're a small or large employer, you're probably wondering what bucket you fall into. So let's look at whether you're a small employer or a large employer. The employer determines the average workforce size by counting the number of employees, and that includes full-time, part-time, and seasonal employees on the payroll during each pay period of the prior calendar year and dividing by the number of pay periods. This count determines then whether you are a small or large employer in the current calendar year. 1099 contractors count towards your total number of covered individuals only if they make up more than 50% of your total workforce. If those 1099 workers comprise more than 50% of your total workforce and the total number of workers, including the contract workers, is greater than 25, then the employer has to pay for the employer's share of contributions for each 1099 worker as well as for the W-2 workers. Okay? Just a reminder again, the employer is determined by the Federal Employer Identification Number. This is not the control group rules. Okay? Let's talk about which workers does the employer have to make contributions for. In this day and age, I know we have a lot of remote employees. So briefly, these are the categories of employers. The category of employees for which employers need to make contributions for. First one is an employee that works in Massachusetts. That's pretty straightforward. The second one is if an employee works primarily in Massachusetts, so they spend the majority of their time in Massachusetts. The third category would be an employee that works all over, but his base of operations is in Massachusetts, or maybe the headquarters are in Massachusetts, or that's basically where the employee gets his directives from. The fourth category would be, for example, your remote employees. Let's say the employee lives in Massachusetts, maybe the employer is in Utah, there's a remote office somewhere, but the employee actually resides in Massachusetts, then they would have to make a contribution for that employee. And if you're a K-1, you must opt in. So there's no guidance on the W-2 and K-1. So covered contract workers, again, if the employer is a covered business entity, and really at the end of the day, when you think about it, where does the employee spend the majority of their time? Where are they getting managed out of? Do they reside in Massachusetts? If all of those are check boxes, then the chances are that the employer is going to have to make a contribution for them. Okay. In terms of the poll results, if your organization plans to pick up some or all of the employee contributions, the answer is yes for 19%, no is 43%, and 38% are not sure yet. So I know we're getting close to the hour, so we're going to just start wrapping up here with action items. Most important thing, you got to get those posters in place. Determine if your organization is going to apply for a private plan exemption, and we're going to talk about things to consider on the next slide. Consider the integration with your existing employer disability and leave programs. Also think about whether you have employees in other states and if they're in other statutory states. So as you think about your internal policies and programs, you're going to want to evaluate how the Mass PFML benefits will compare to the benefits available to employees in other states. This is really important, especially if you have employees in states that have, family medical leave laws like New York, Rhode Island, New Jersey, and California. But a lot of the states surrounding us, like Connecticut, Vermont, New Hampshire, they're actually considering PFML laws of their own. So I think pretty soon that will be the norm. But you're going to want to think about how that affects the different locations. Determine your organization's contribution requirements. Do you have to make contributions for those independent contract workers? Are you a large employer or a small employer? And what percentage is the employer going to pay? Make sure you get those employee notices out. And most importantly, the acknowledgments. Those need to be done by June 30th, so please don't forget that. Make sure you're set up on Mass Tax Connect now so you can report the earnings, and everything else really goes through Mass Tax Connect. Even your private plan exemptions go through there. And you probably will have to amend your employee documents, like your handbooks, your company policies, to address the coordination with those. One of the last things we want to talk about is the private plan considerations. For those of you that are thinking about private plan considerations versus the public option, a couple of things to think about here. If you are doing a private plan, there's probably going to be faster claims review and payment of the benefits. There's probably going to be improved reporting capabilities. The employer doesn't have to wait for communications from the state to understand whether the leave has been approved or denied. You're going to have more of an ability to integrate the PFML leave administration with some of your other company-sponsored STD or other leave policies. And there may be savings with the self-funded arrangement. It really depends on the employee demographics. So think about if your organization has a history of low leaves, then might be a good option for you. If you have a younger population and you don't historically have a lot of STD or family leave claims, that could be a way for you to go and to save some money. These are some really helpful resources for you for Mass PFML. The one is a YouTube on the private plan exemption, tells you how to submit that, and the website, as Susan said, has some really, really great information for you. So thank you so much for attending. I know we are now, it's 2:03, so if you have to get off the line, just a reminder that we will be sending the questions along with the recording of the webinar to all of those that have registered for this webinar, but we will stay on the line for the next few minutes and start answering some of the questions. So if you want to stay on the line, you're welcome to do so. So with that, I will start looking at some of the questions. Okay, so the exemptions for the private plan applications, those are due September 20th. And again, you do that through Mass Tax Connect, and that YouTube video will help you figure out how to do that. If a qualified condition comes about before January 1st, 2021, will the employee be eligible for benefits for that condition, i.e. maternity leave that starts in November 2020 and continues into 2021?
Well, possibly they will, yeah. I mean, I don't think that there's any, I haven't seen any regulations that said that the condition must begin before the benefits are available. That's a really good question.
I think we'll probably get more guidance on that. They would have to be filing a claim.
Yes,
you know,
exactly, that's exactly right. I do remember that when the New York State Family Leave Disability and Family Leave Benefit became available, for employees who gave birth in the year before the family leave benefits were available, they were able to take child bonding leave during that 12-month period following their birth, as long as that occurred after January 1st of that year. Okay. So I think it's very, very likely that a condition that begins before January 1 may be covered to some extent in 2021.
But I think stay tuned is the answer there.
Right, exactly.
In general, does this new law apply to household employees, for example, nannies, property managers?
Yes, actually it does, but there is a state agency that is going to be set up to address those claims. So it's not like the homeowner will necessarily have to provide those benefits to a domestic worker, but a nanny will be able to get benefits through the state program.
Okay, the next question. If we offer STD for a maternity or own condition, will that employee on leave receive additional payment from the state? So again, this is that offset scenario. So if the employer is providing 100% benefit, then the state will not supplement that because you don't want to pay over 100% to anyone on leave. Whatever amount the employer is paying will be offset from the state amount. So there's a chance that the employee would receive both, but again, you're going to offset it so that you're combining the employer plan and the state plan. And if the employer does pay for, let's say, 100% of that, they will get reimbursement for the state portion that they would have paid for that employee.
Right. But also, we know that for fully insured STD policies, we expect that those STD policies will be amended before 2021 so that the policy will be designed to offset a benefit for what the state pays first. Mm-hmm. So the STD, the fully insured STD policy benefit will be reduced, and the state benefit then would stay the same. So it depends on the situation. What
is the best practice on recouping benefit employee contributions? They should pay while out every week or month or double benefit costs when they are back for a certain amount of time. Oh, I see. So you want to know whether they should pay while they're out, per week or per month, or just double the benefit costs when they're back?
If a person is not receiving pay, you can't do a deduction. It's going to be the same as like a FICA tax. So it's not like an employee will pay in arrears. That's not going to be the situation. Instead, whenever an employee gets a paycheck, a contribution will be taken from that paycheck. And so if an employee is not getting a paycheck, there will be no contribution due from that employee for that particular period of time.
Is there a calculator tool for determining the pay?
Yes.
There is on the
yes,
website.
Yes, the state website has calculator tools for both employer calculations and employee benefits. And I think that we're also developing a little calculator tool in-house. So some of our clients might want to use that as well.
But you can go to that link, the mass.gov/WFML, and that will, from the department, that has really helpful information. Yep.
Right. But at the end of the day, your contribution cost is going to be determined by the earnings report that you send to the state agency at the end of each quarter. And the state will determine how much you guys owe based on your earnings reports.
The former employee eligibility requirement need to be included in a private plan in order to be exempt from the state plan? Yes. Yes. Those private plans really need to mirror every single aspect of the state plan, and that would be one of those eligibility requirements that would need to be included in the private plan.
So employers covered by a collective bargaining agreement also covered? Yes, they are.
Can an employee receive payment under this as well as STD, LTD, and unemployment compensation?
Well, they could, but there will be offsets. So depending on what type of benefit the employee is receiving, one or the other will be offset. So if a person is getting workers' comp, the MA PFML benefit will be offset for the workers' comp payment. If a worker is getting LTD, I believe in that case there will not be an offset, you know. So it depends on what type of benefit they're getting. And the state will have to know what type of benefits a person is getting before the state calculates the benefit to be paid to that particular employee.
If an employee contributes to this plan and never files a claim, what happens to their funds? Great question. If a terminated employee doesn't file a claim within the 26 weeks time frame, will the employer get their funded portion back? Great question. So, yeah, no.
No, sorry.
Sorry, but no, the employer is not getting their funded portion back. No one's getting their funded portion back. Sorry.
Right. In that sense, it's working a little bit like Medicare or your FICA taxes or your Social Security taxes.
You pay them
Everybody's going to be paying in.
Yeah.
You may or may not get your benefit.
Right. That's right. Does the employee have to provide this info, start date, end date type of leave, directly to the state of Mass or to the employer? So in that notice provision will go to the employer as well as to the department, and it will have all that information in it.
Right.
Yeah. Does someone who lives out of state, for example, in Georgia, but works for a Mass employer covered by this law? Absolutely, yes.
Yeah, if they're working in Massachusetts.
Yeah.
So they have to be working in Massachusetts.
Yeah.
But we do have clients with remote employees in other states, and if they get their direction from the Massachusetts office, then the current guidance is they're going to be covered.
Yep. If an employer says they'll pay 100% for the person's leave, what happens to the funds that the employer and an employee have contributed? What benefit would an employer have in paying twice?
Right. So if an employer pays 100% of the person's leave, the employer has the option of applying to the state for reimbursement of the amounts that the state would otherwise have paid to that employee. So in that sense, you know, the employer gets the benefit instead of the employee. So it's not a total loss.
My first payroll in July is for wages earned in June. Should I use this payroll or wait for the first payroll with July wages?
Well, the rule here is that the deductions come from the first payroll that is issued to an employee on or after July 1. Okay, so that's the earnings report that is going to be sent to the state. The state is only going to get earnings reports for pay that is issued to employees during the month of July, regardless of whether that is a prospective payment or a retrospective payment. The state really isn't concerned about that. The deductions will come out of that July pay and from pay going forward.
I heard that the electronic email read receipt is not good enough acknowledgement. Is that correct?
Correct.
That's correct.
That is correct.
That's correct. So that automatic electronic mail read receipt is not sufficient. You have to have the employee acknowledge receipt, like proactively, actively, I guess you should say, acknowledge receipt.
Yeah. Sometimes you can get an electronic signature back from the employee, which is not the same as a read receipt.
Right. Yep.
When you say notice must go to all employees, do you mean only eligible?
When you say notice must go to all employees, do you mean only eligible employees? Yes.
No, we mean all employees.
Well,
all employees.
when you say notice must go to all employees, do you mean only eligible employees? Well, it's eligible employees and new hires and also terminated.
Yeah, but I think when this questioner is talking about eligible employees, they may be talking about employees that could be eligible for the health plan.
Oh, no.
Right,
I mean eligible employees under the eligibility that we talked about, the eligibility test that we talked about in this presentation, which is if they've paid,
so they have to be Massachusetts
unemployment, that category, those are the eligible employees.
Right.
So it's not your eligibility definition for health benefits or anything else specific to your employer.
Yes, all of your Massachusetts employees, part-time.
Yep,
Okay,
part-time, seasonal, yep.
Temporary,
Right.
anybody you hire for any period of time, anybody that you get paid, that you pay a W-2 for.
And I think we addressed the eligibility of employees in the presentation, so you can refer to that as well. For the employee acknowledgement, does this need to be signed by June 30th or distributed by June 30th?
They should be actually, when the state says something is, the notice is due by June 30th, the state's interpretation of that is that the employee has signed by June 30th. Okay, so that would be the best practice, would be to collect those signatures by June 30th.
Right. For employees who resign of their own will and are not terminated or laid off, are they still eligible for 26 weeks? Yes. Yes. Or is this only intended to protect those who have lost their job in some way? No. The 26 weeks applies to an employee who has left regardless of the reason. Is there a cost-benefit analysis to determine if a company should go the private route versus through the state? Well,
kind of we're developing that right now, really. That's a very employer-specific situation because we kind of know what the employer costs would be to participate in the state plan, okay? For a self-funded plan, we can only guess what those costs would be. And for a fully insured plan, we don't really have all the rates yet.
Right. Will the carriers be able to provide plan documents for self-funded plans, or does the company need to create one?
We believe that the carriers who are addressing self-funded plans they plan to do that.
Yes.
We haven't really seen a document yet, though. It's still too new.
Right. We're coming up with that. Let's see what else we have here. Could you talk a little more about how the state plan would be offset with a fully insured short-term disability plan with a 60% benefit?
Yeah, so if you tell the state that your employee is going to receive a benefit from your fully insured plan, if you have a fully insured plan, again, we expect that before 2021, those fully insured policies are going to have a provision in them that says that the 60% benefit in this case would be reduced by any benefit expected to be received from the state. So let's say for an employee who earns like $1,000 a week, the 60% benefit would come to $600, okay? The state is going to say, well, they're going to give that person $700 as a benefit. That was, I think, what we covered in our numerical example, okay? The STD policy is going to calculate that that employee is going to receive that $700 benefit, and they're going to offset the 60% benefit for the $700. So in this particular case, that employee is really not going to get anything from the STD policy unless there is some minimal benefit that policy is designed to pay, like $50 or something like that, because the employee is already getting more than 60% of pay from the state in that case.
We will be distributing the slides along with the recording to all those that have registered for the webinar. Okay, last one. Will Paychex be submitting all the wage info to Mass Tax Connect?
We expect that employers will need to communicate with their payroll providers, number one, to confirm the employer versus employee contribution amounts. So the payroll providers won't do anything automatically, but they are definitely getting set up to address this reporting that will go through the Mass Tax Connect portal and to pay those premium amounts.
Okay, so I know we've run way over and there's still a lot of questions. So thank you to everyone for joining us today. We hope you found this helpful. I know it was a lot of information thrown at you. As always, we try to stay on top of all your compliance needs and your regulatory changes, so we'll continue to update you as the department releases more information. You will receive a recording of the webinar, a copy of the Q&A, and the slide deck over the next few days. If you have additional questions, you can reach out to Susan or myself directly, or the EBS team that you work with. Thank you so much, and have a great, long, and safe weekend. Thank you.